Hey, good evening, everyone. Marty Mazzora here, Friday, 21st of October, 2022. This would normally be your weekend stock market snapshot, and that's what it's going to be. I'll get to the charts of the S&P 500. As I suggested on the economic video earlier, I wanted to get a bit into the weeds of other places like currencies and fixed income and so on. Sitting here putting that together, I think what it's going to end up being is just another monologue from me. And then, yes, some charts trying to illustrate what I'm talking about. But suffice to say that there is just a plethora of issues out there to be thinking about, to be concerned about, that have potentially systemic consequences if they go in a certain direction, that no doubt in my mind whatsoever that the Fed is now growingly concerned about, to the point where suddenly, literally suddenly, there is a marked change in tone with some of them. Meaning that just within days or weeks ago, we were hearing that inflation, we're not seeing any sign of it abating. We're going to have to be aggressive, maybe even more aggressive than we threatened yesterday. Two, we see rate hikes in the future probably coming in smaller increments. No reason to go too far too fast. Pausing next year, just a real flip with a number of them. And clearly, when those changes in tone are sniffed out by the equity market, it rallies like it did today. Why would the Fed, amid continuing high inflation prints, begin to change its tune a bit? Well, we've had the situation in the United Kingdom where the new government, which is no longer there, amazingly, offered real supply-side measures that are just not consistent with the current inflation setup, or what I believe to be a new regime going forward that we term labor-friendly regime, as opposed to the capital-friendly regime that we've lived under for the last 40 years. So supply-side measures, corporate tax cuts and so forth just don't sit well. Even though it really wasn't that big, what they were proposing in the grand scheme of things, it was enough to send the pound into the gutter and send yields through the roof, to the point where, and I've already talked about this previously, where the tide went out on a naked UK defined benefit pension system that was so leveraged against UK government bonds that margin calls were about to occur that would have just been utterly devastating. And when a big institutional investor or a big institutional fund that's obviously very diversified in global securities, including those in the US, is threatened with massive margin calls, well, they need to sell what's there, including the already beaten down gilts, UK government bonds. But if you can't really get much of a bid there, you sell the good stuff. And no wonder global markets, no wonder the US stock market appeared to, on that news, roll over hard on multiple days as this thing was all shaking out. And then you have a lack of liquidity. In fact, let me show you that chart. This is the US government securities, called the Treasury Liquidity Index. And as this line goes up, that means liquidity in the Treasury market is going down. Now, on October 10th, when asked, our Treasury Secretary, Janet Yellen, said she sees no issues around liquidity in the Treasury market. On October 11th, apparently she was flirting with the notion or discussing the notion of actually doing buybacks, where the Treasury presumably would issue short-term Treasury bills and buy longer-term, off-the-run, so to speak, Treasury debt, and essentially call it a duration swap. Replace that debt, so to speak, with shorter-term debt and ultimately, as you reduce that duration, it feels like, certainly with its potential impact on asset prices, like quantitative easing. Now, when you think through that, you say, well, the Fed is actually engaged in quantitative tightening, and that actually puts asset markets at some serious risk. They're actually reducing bond exposure on their balance sheet. Well, if the Fed is there actively buying longer term bonds and shortening duration, to some degree, it allows the Fed to reduce its balance sheet, perhaps, and continue to do that, which is a process that might ordinarily really have something crack with some big levered players levered to treasuries, other debt instruments, equities, and so forth, if markets can really come tumbling down and have some sort of systemic issues going on, and suddenly we're having flashbacks to October 2008. But if you got the Treasury effectively doing this duration swap, well, then to some degree, or if not entirely, that offsets what's going on there, and it could be pretty bullish for equities and for asset prices. So the fact that these conversations are being had and these tools may be being brought to bear ultimately on the market sends the message to the market that, yes, on one end, we should be very concerned with things like Treasury liquidity, with things like Treasury volatility, the so-called MOVE index, which reflects implied volatility on Treasury options. And so you see how high that's gotten, and you see how high it got during COVID and during 2008 and so forth. So we are at levels that tend to occur when things are, let's just say, cracking at this point, right? Now, this is things that people who just are prone to bearishness really go after and illustrate for you and see things are cracking, things are breaking. Well, suffice to say that it's also when these things peak and begin to come back down, you can expect the corrections or the bear markets and equities that are occurring at that time to find their bottoms and begin to come roaring back up. So I think without question the Fed is getting a little nervous. I think the market again is sniffing that out, and we're seeing some rallies as a result of that. And this is happening at a time when we have very weak sentiment, standing room only. On some days it seems like on the bear side of the boat, as you get something and then they all run to the bull side of the boat and stocks go to the moon, so to speak. The best seasonality of the year, frankly, going forward. Traders know that. An earnings season where we came in with deteriorating revisions from analysts, and typically when you have net negative revisions, ironically, like 83% of the time or something like that, it's a lot. The stocks end up going up during earnings season. And so you've got these dynamics that just kind of come together, and you've seen this on many of our latest blog posts, suddenly saying, oh, we're starting to check some of our bottoming boxes, and we're not even really officially in the recession that we believe we're ultimately going to be in, but we do believe it's going to be a mild one. So you've got these dynamics going on in the fixed income market. Let me throw at you something that I don't normally show you here, although we were looking at these sorts of things, if you recall, back during the COVID lockdown. Foreign exchange liquidity swaps or Fed liquidity swaps. It's where foreign central banks can come to the Fed and actually swap their currency for dollars. They pay a premium for that or an interest rate on that, and there's a specific term, and then they swap back at that rate on the way back out. And the Swiss National Bank just came in with a huge $6.3 billion use of that swap line, and it's one of the banks where it's just continually there for them. You can see how much they used it during COVID. That is just massive relative to what we've seen in recent history when it was really necessary. So what does that say? That's not that the Swiss National Bank is necessarily in trouble, but there are entities around it that are and need US dollars right now to service their dollar-denominated debt and so forth. So so Swiss National Bank can essentially go to that window, trade for dollars, and then facilitate the liquidity for these other places and probably arbitrage a spread in between, pick up a bit higher interest rates than what they're paying to the Fed to access this swap line. Why am I going there? Well, because it's just another indication that there's stress out there. There's things out there to be concerned about. And I keep maintaining again and again that the Fed is aware of this. And now they're starting to get concerned. So is it, as some people would suggest, time to pack up and get out of Dodge, so to speak, speaking of the market? Or is it the time to expect the powers that be to jump in and start coming up with ways, creative and traditional and otherwise perhaps, to provide the liquidity to calm these waters in a market that's, down 30+% when you talk about the NASDAQ composite, 20+% when we're talking about the S&P 500. Treasury yields that have gone through the proverbial roof. Take a look at TLT, which is the 20+ year Treasury ETF that we not long ago added as a core position. It just continues to get absolutely walloped. It is in a massively oversold state. That's what this means here on the relative strength index. If you have folks who are leveraged in the treasury market, like folks were leveraged in the gilt market, the UK government bond market, and the value of those positions that they're levered against goes down like this, you could have issues there, like they had in the United Kingdom. And again, when you hear Janet Yellen starting to get concerned about Treasury liquidity, they're concerned about how big that can be and what the contagion effects might be. So these are things that have the Fed thinking and worrying. So just stay tuned, folks. We'll get more into these weeds as they thicken or thin, or as this bear market continues to shake itself out. It's less than average in length so far. It's less than average in terms of depth, in terms of the degree of loss. But I don't know that we need to see 40% declines. In fact, recall, folks, that as this bear market began and we began doing our technical analysis, we came up with a bear market price target of 3,500. And last Thursday, this is a weekly chart. Last Thursday, we hit it and bounced off of it like a pogo stick. As our thesis has evolved, you know that we have suggested now that we're probably going to see something lower than that, because we do think that recession is almost upon us. And in a recession and what that typically does to corporate earnings, we should expect something below our price target, because when we set that, our economic assessment was no recession at the time. So now it is yes recession, albeit a mild one. So this really could stick. If these systemic issues are addressed, if the central banks and the governments of the world get in front of those in here, this may be all she wrote, quite frankly. But we're going to continue to act as if it's not, that it's going to at least get tested a few more times, probably break through. But as I've alluded to on the written blog, some shifts are coming to our core portfolio. Our long-term thesis comes up with some serious value, a lot of it in other parts of the world that we want to continue to exploit or add to as we move forward. So lots to consider as this bear market shakes itself out. But I'll tell you, we're still focused on protecting. We're still, we have, out of the money, relatively short-term SPX puts, S&P 500 puts that are there to protect against tail risk, left tail risk, or downside risk if it were to develop very, very quickly and we get these waterfall sell-offs. Anyway, so let's just go ahead and continue with the S&P analysis here. So we've got, again, the weekly chart. And as I've alluded to lately, it's starting to get more and more bullish really by the week. And so we've got a downward wedge pattern. We're still in, we're still not breaking above here for that official buy signal, but we've got growingly positive divergences on the MACD and on the RSI. On the daily chart, today the S&P actually developed another massive engulfing candle. So let me get that out of the way. This big green candle today actually engulfs the previous 3 days, which from what I understand is very rare. We just did it just last week, right? And now we just did it again. And that is unambiguously bullish. Technical sign there, technical pattern. Okay. I threw in today the 20-day moving average. Notice how during the sell-offs that we've had so far, it had been pretty stiff resistance. You break through that, and we've been getting some pretty good rallies, right? Then we break down, resistance all the way, we break through it, boom, strong rally. We break down, resist it a little bit, stay above it, really big rally, right? Break down, test it, test it, test it, test it, all the way down, broke through it, came back, and have been back testing it and have succeeded the back test, and it's beginning to slope higher like it is here. So another indicator that, maybe at a minimum, we've got a nice bear market rally. And I keep making that case, with the seasonality, with the pessimism, the bearishness that's out there. Mutual fund managers, according to the B of A Mutual Fund Manager Survey, have more cash than they've had on hand since like 2001, and 49% say they're underinvested in equities. You just have this setup that says you get a little good news and people realize the season we're in, and you break through some technical levels, and you have days like today. But clearly what we learned yesterday is the Fed can really throw cold water on that if they want to. But it's beginning to look like the Fed wants to be more accommodative, and they're actually worried now about the systemic risk in asset prices collapsing. And then today, we had the Bank of Japan step in as we fully expected. Nick and I were literally talking about it right before it happened, stepped in to strongly support the yen that has been literally in the gutter here of late and becomes problematic. And so the dollar rolled over. I think it was up like 1% at one point during the day, and it rolled over hard, and the yen went to the moon. That was very bullish for stocks today when the dollar came down. And I did load up a dollar chart, but I'm going to get so long here that I'll save that for another time. So the daily chart looks doggone constructive still. These bullish divergences are just gaining steam. This is that buy signal here on the MACD. So we'll see. Next week you get the FANG stocks reporting. Technically, it looks like we may go into there with some momentum. We had a pretty good options expiration day today, and if we, according to our experts there, if we could push much above 3,700, that would be resoundingly bullish going forward, and that's exactly where we are right now. That could flip on a dime, but that's also a bullish factor that we're looking at going forward here. And then lastly, let's look at the hourly chart as we normally do. We broke above this area in here, and there's this gap was on the daily as well. So the hourly broke above the gap just like we did on the daily, and closed above there. Let's gain some momentum, basically breaking above this pretty significant line right here of support and resistance, breaking through there with some momentum. If you can get in, if you get this up here and you get a good positive slope there on these, and then suddenly you're off to the races potentially. And from here, you'd run into potentially some resistance right at that 3,800 mark, almost no doubt about it. That's a nice move from here, that there's going to be some choppiness right in there. You break through that, and suddenly you're looking at about 3,900. And, all this could happen within the time frame of between now and the end of the year. When you think about that seasonality and you think about the shift that could happen from pessimism and fear to fear of missing out. So while our expectations still say, it wouldn't be tough to penetrate that 3,500 mark, it doesn't necessarily have to happen this year amid all these other things that are developing. Right, we've got the Fed meeting on November 2nd. Of course, we have midterm elections coming up, of course. We'll talk, I'm sure, more about that here in the next week or so. Big election in Brazil on Halloween. So, there's a lot going on in the world politically and geopolitically as well to parse. This weekend, got a lot going on, so I don't know that I'll be back. I will, if at all, it'd be late Sunday, and I'd have to have a good reason to bother you. Other than that, look for the morning note Monday morning. Thank you as always for watching and listening. Hope you have a wonderful weekend. Bye-bye.